Now, what we have is $35 trillion of debt, and something that nobody talks about, well, a few people talk about, is $215 trillion of unfunded liabilities, the vast majority of that in Social Security, Medicare, and Medicaid. And so this is the ultimate Ponzi scheme now, because by the time I retire, that fund is depleted. And so I might get 60 or 70 cents on the dollar as it stands now. The only way that can be avoided is by either raising the taxes on future pay-ins or cutting my benefits. That's the only way we can reconcile this. The only third way we can do it is just print more money and ensure that there's tons of inflation and somehow fill that gap.
The past few days have been challenging for global markets, with U.S. stock futures tumbling on Monday amid growing fears of an impending recession in the world's largest economy. The S&P 500 futures dropped over 3.2%, following a 1.8% decline on Friday, while Nasdaq futures fell by 4.7% and Dow Jones Industrial Average futures decreased by 2.2% after a 611-point loss. This turmoil has sparked a worldwide stock market sell-off, with Japan's Nikkei 225 suffering a 12% plunge, its worst single-day decline since the 1987 Black Monday crash. The cryptocurrency market has also been hit hard, with Bitcoin falling more than 16% to a multi-month low of $51,000, and Ethereum dropping over 23%. Reports suggest that Friday's disappointing July jobs report triggered this global market meltdown, intensifying fears of a U.S. recession. Concerns are also mounting that the Federal Reserve's prolonged high interest rates could severely impact the U.S. economy. Despite the widespread market downturn and fears of further price declines, cryptocurrency investors have shown resilience, with many viewing this as an unexpected but promising buying opportunity. Real Vision founder and CEO Raoul shared optimism on social media, describing the recent declines as temporary and the market as still on track for the banana zone. Similarly, in an interview with Kitco's Michelle McCory, Bitcoin enthusiast and macro analyst James Lavish expressed confidence in Bitcoin and the impact of Federal Reserve liquidity on the market's future. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
Let's be clear. Bitcoin has been, for a long time, it's been the tip of the risk spear, right? So it has benefited from risk asset inflation. And so as risk assets, as more money have come into risk assets, it's gone into Bitcoin as well. And Bitcoin being a super volatile asset, it's done well on the volatility to the upside. But remember, Bitcoin has had a tremendous run over the last year, this year in particular, because of the injection of capital coming through ETFs, and that's been a great development for Bitcoin. And I believe that it's going to spur more institutional investors to do their homework, learn about the asset, see why it's different, and have a true understanding of it, and then add it to their portfolios in a separate allocation. And that's really the progression that we're looking for here. We're not there yet. It's taking institutions a long time to get comfortable with this asset. However, if you look at this chart, you can see that along the way throughout the last, over the last, I'd say 9-11 months, you can see the orange line shows you where that Bitcoin drawdown has been from the all-time high, whereas where the NASDAQ is, and they're right on top of each other. So Bitcoin did have a drawdown over this last number of weeks, but that has to do a lot with what's been going on in this election. You had a nice run up, tried to get through the all-time highs again. It looked like Trump was going to be like just sweep. It looked like he was going to win a landslide a month ago, and right when he almost got assassinated, you could see Bitcoin jump back up. But then, as this whole thing is played out, Bitcoin has kind of drifted a little bit. But look at where it's come to. So it's right on top of where the NASDAQ is on a drawdown from the all-time high. So this is really interesting as you look at this chart, you can see that Bitcoin had a very nice run from the creation of those ETFs. It got to that all-time high, but since then it's been consolidating, and this has been healthy to me. It's been super healthy. If you remember, Michelle, the last time we saw Bitcoin actually act as a risk-off asset was when people's money was being threatened. And that was back in the Silicon Valley bank disaster. So during that disaster, and when that looked like it was going bankrupt, and it ultimately did, Bitcoin rallied, and Bitcoin did well during that time. And that's because people they woke up and said, oh my gosh, my money is not safe in the bank. Well, of course, the Fed came in and said, yeah, it's safe. Don't worry. We're going to come up with these acronyms for these bailout programs, and your money's going to be safe here. So don't panic about that. So Bitcoin kind of went back to where it is, and people haven't had to learn about it yet. What we're looking for is some sort of disruption in the market that is like that forces Bitcoin to be the risk-off asset. It's not there yet, but I believe as we get more institutions understanding and allocating to it in their portfolios, it will get to a size that it will be a store of value, a true store of value with lower volatility. It's just natural, as it's only a $1 trillion asset right now. If you look at the overall assets in the entire world, the investable assets in the world, you're up at about $900 trillion worth of investable assets. Bitcoin's just a fraction of that. It's like 0.15%. If you get 1% of those investable assets, Bitcoin's going to be trading over $400,000.
During the conversation, James Lavish also shared his thoughts on the current state of the U.S. economy and the market's reaction to Friday's jobs report. The Bureau of Labor Statistics revealed that the U.S. economy added only 114,000 jobs in July, while the unemployment rate increased from 4.1% in June to 4.3% in July, the highest level since 2021. This unexpected rise in unemployment triggered the Sahm Rule, which indicates a recession is underway when the 3-month average unemployment rate jumps by more than half a percentage point within a year. According to Federal Reserve data, the current Sahm Rule reading has climbed to 0.53% from 0.43% in June. Despite the rule's historical accuracy, its creator, Claudia Sahm, suggested this may be an exception where the reading doesn't necessarily signal a recession. On Friday, while speaking with reporters, American economist Claudia Sahm expressed her belief that the current situation might differ from past recessions. She remarked, "I am not concerned that at this moment we are in a recession. This time really could be different. The Sahm Rule may not tell us what it has in the past due to these swings, from labor shortages with people dropping out of the labor force to now having immigrants entering the workforce. All of this can affect changes in the unemployment rate, which is central to the Sahm Rule." During his interview with Macquarie, Lavish noted that the widespread belief among policymakers that this time could be different is precisely what has led to the current situation. He pointed out the irony of this perspective, suggesting that such thinking may have contributed to the economic challenges being faced.
We have seen the NASDAQ, it has topped out for now, and we're seeing it back off from those highs because, I mean, let's admit it, we've had a tremendous run from the AI injection of excitement and enthusiasm in the space. So that was natural. But now what we're seeing is we're getting some indicators that are not that great out of the economy. Earlier this week, we had the Fed speak. We had Powell get up there and indicate that they're not quite ready to cut rates yet. Obviously, they would have cut here in July if they were ready, but they weren't. And so, but he did say, well, we could see a rate cut in September is basically the messaging he gave, but it wasn't strong enough to give the economy, to give the markets enough confidence in that the economy is going to stick it through while the Fed sticks that landing, which is the soft landing that they keep talking about, that ever so elusive soft landing. But we're seeing some difficult numbers coming out of the economy, and we got one today that actually is technically it's shown to trigger to show that the recession has already been triggered, and it's called the Sahm Rule, and it just is an average of the last 3 unemployment readings and how much it's above that that ultimate low. And so the low from last year, and it's up over 0.5. If it's over 0.5, that's technically in a recession area. We can get into a debate about how many decimal points you're supposed to go out when you calculate these things. But if you just look at this chart right here, you can see that every single time in the last however many recessions we've had, once it hits over 0.5, we're already in a recession. And so that has the market a little bit spooked today. One of the hallmarks of mistakes in Wall Street is that statement, "It's different this time." And so we just have to be really careful about that. Does history repeat itself? Well, I mean, we've seen how strong this indicator is. It's not something to be brushed off or ignored. It's something to very much have your attention on, and to know that once the economy starts down this road and we do start losing these jobs in earnest, it's a very difficult momentum to try to stop. And so we're talking about a Fed here that raised rates at a meteoric pace, and now they've been holding them high in relation to where they've been over the last 20 years. And we're in a situation now that the Fed is they're up against the wall, and they could run into a policy error here if they don't start thinking about lowering rates soon and at least giving the market that nod. The market gave the clear indication today that they're ready for a rate cut. And if you look at the Fed funds rate and where the probabilities of the cut, I can share my screen here and you could see this, but the probability of a rate cut now is over. It's basically 100% for the next meeting, which is in September, and they're expecting not just 100% cut there, but they're expecting another cut on top of it. So almost an 80% chance of another cut, which means 50 basis points in this next meeting. So they're really pushing the Fed here to say, we expect a cut. Yeah. And so that's what the market's telling them. Now, whether or not they're right, this is the question. Should they cut in September? Absolutely. At this point, it looks like they should be cutting in September. The question is, should it be 25 basis points or 50 basis points? And that gets me to the point of, well, maybe if we keep getting some difficult economic indicators here, some they're showing that the economy is not that rosy, you could see an interim meeting rate cut. We've seen that plenty of times before in the past. And we've got an election year. There's a lot of political pressure. I could see that happen. The likelihood of that, I mean, I would say it's less than 50%, but it's way higher than 0%.
James Lavish remains hopeful that the Fed will announce an emergency rate cut before the next FOMC meeting in September, though he acknowledges that such a move by the central bank could spark even more panic. He explains that if any more negative economic indicators emerge, Fed Chair Jerome Powell may have no choice but to make the anticipated announcement ahead of the scheduled meeting. Since the release of the jobs report on Friday, Powell has faced mounting pressure, including criticism from Senator Elizabeth Warren on Twitter. Over the weekend, Warren tweeted, "Fed Chair Powell made a serious mistake not cutting interest rates. He's been warned repeatedly that waiting too long risks driving the economy into a ditch. The jobs data is flashing red. Powell needs to cancel his summer vacation and cut rates now, not wait 6 weeks." Do you think Powell will succumb to the pressure and announce an emergency rate cut before September? Share your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.